Reinventing index investing. Finding an edge without falling off the cliff. Most people know the rough rule of thumb. The S&P 500 returns about 10% a year on average. That's been the backbone of retirement accounts and index investing for decades. But in today's atmosphere of better, faster, stronger, 10% suddenly feels pedestrian. We live in a culture where everyone wants an edge, to beat the system, to double their money overnight. And that hunger has driven many into risky corners of the market. Crypto, meme stocks, speculative startups. The problem? These aren't investments. They're gambles. And like any gamble, the odds tend to favor the house. For every story of someone striking gold, there are countless more of investors who saw their money vanish. Right now, investors are forced into a false choice. You can have the safety and stability of traditional index investing, but settle for slow growth. Or you can chase the promise of oversized returns in high-risk assets and roll the dice with your financial future. What's missing is the space between. The middle ground where you don't abandon stability, but you also don't surrender to single-digit returns. That's the space we've set out to fill at LymanWealth. We do so by reinventing index investing. Here's the LymanWealth difference. We don't gamble. We engineer. Our strategy targets 30 to 50% annual returns, not by betting big, but by applying a disciplined system designed from the ground up. At the core are two old, time-tested ideas: dollar cost averaging and value averaging. Most investors are familiar with dollar cost averaging, steadily buying in over time, regardless of price, so that you don't overcommit at a market peak. Value averaging adds another layer. It means adjusting how much you invest depending on whether the market is ahead or behind your growth target. Buy more when prices are down, buy less, or even sell a little when they're up. Now, apply these principles not to plain index funds, but to leveraged index ETFs, funds designed to magnify market movements. Done recklessly, leverage is dangerous. But when you blend it with dollar cost and value averaging, something interesting happens. The risk is controlled, the gains are harvested, and the compounding effect accelerates. Think of it like driving a sports car, but with traction control, anti-lock brakes, and a disciplined driver behind the wheel. The car is capable of speed, but the systems keep it from spinning out on the curves. Let's be clear, leverage is not for amateurs. Left unchecked, it's a race car with no brakes. Exciting until the first sharp turn. That's where engineering makes the difference. Our system doesn't eliminate risk. No investment does, but it modulates it. It keeps exposure in balance, trimming at highs, buying at lows, and reinvesting gains along the way. The result, participation in market growth, with risk harnessed instead of ignored. We're not inventing a new market or speculating on untested assets. The foundation remains the same: broad exposure to the market itself. What's different is the twist. We're applying technology, quantitative analysis, and engineering discipline to amplify what works and buffer what doesn't. It's still index investing. It's just index investing reinvented. So here's the choice. You can stay with slow and steady, watching the index climb 10% a year. You can roll the dice on crypto or other fads, hoping lightning strikes. Or you can take the middle ground, an engineered strategy to target higher returns without taking on blind risk. That's the LymanWealth approach. Not gambling, not guessing, just a smarter way to harness the market you already trust. If you're ready for a smarter, risk-managed way to grow your wealth with index investing, contact us at LymanWealth.com and let's get you started.